Everybody, it's time to cover PayPal mistakes now. Welcome back to Strongman Personal Finance. So PayPal just released earnings, and the stock is going vertical, bro. It's up 4%, a massive 4% after hours. This is basically meta stock. Easy money, right? Anyway, so PayPal is a pretty decent company. I like PayPal. I use them. I think it's a fantastic company, fantastic service. There's security when you buy stuff from potentially shady websites. There's a lot to love about PayPal, but there's also a lot to not like about PayPal. And I've discussed those items before, but what we're going to do in this video is just go through the earnings slides, and I'm going to give you my thoughts. I really haven't, I skimmed through these briefly, but I'm going to give you my basic thoughts. So the first thing I noticed is that total payment volume has grown by 15%. So there are a lot of payments going back and forth on this platform. It grew 15%, which is pretty impressive growth. However, payment volume is not the only metric. It's actually the revenues, the transaction fees they collect from the payments only grew 8%. So while they have more volume on their platform, the amount that they're growing their revenues by is not proportional to the total amount of volume growth. Probably because there's a lot of competition, okay? Operating income of $1.2 billion. So their net revenues, if we take their operating income divided by their net revenue, we get operating income of 16.2%, which is pretty good, okay? I mean, this is a pretty profitable company. If we look at the operating margins historically, it's roughly in line with where it's been before. Nothing crazy, nothing exceptional, but they're not collapsing their operating profits. So pretty good operating income, pretty good operating margin. Operating cash flow of $1.3 billion, free cash flow of $1.1 billion. They're a very profitable cash-generating business. That's not the concern, though, okay? They appointed a new chief financial officer. That's great and fantastic. They're buying back shares. Everything's hunky-dory, right? Well, let's dive in a little bit deeper, okay? I like to look at the financial statements. That's the most important thing because what they put in front of you is not always what you really want to look out for. Because a company, when they present their financials, they present their earnings, they're going to put in front of you the best possible stuff that makes them look the best. But you got to watch out for specific things. So first, let's cover the balance sheet. So I can tell you right off the bat, I'm not concerned about their balance sheet. I don't even have to look at it to tell you that. I don't think PayPal is going bankrupt anytime soon. They have $6 billion of almost $7 billion of cash. They have almost $5 billion of short-term investments, about $1 billion of receivables, loan interest. I mean, they're pretty good. They have $56 billion of current assets on $43 billion of current liabilities. So they're probably not going to go bankrupt within the next year. Their total assets are $76 billion. So if you take out the $56 billion, their long-term assets are roughly $20 billion. Mostly in goodwill, which is an intangible asset, which happens when you acquire other companies. So the vast majority of their assets are in short-term liquid assets, stuff like that. Long-term debts, really nothing crazy. They are a little underwater relative long-term, if you compare long-term assets to long-term debts. The vast majority of their long-term assets are intangible, while they actually have real tangible debt. So that's something to keep in mind, but I don't think it's the end of the world for PayPal. Treasury stock. So we can see treasury stock has become more negative. Treasury stock is when you buy back stock. Simple as that. So you're going to see a negative number because it's a contra equity account. It's the opposite of equity. The normal balance of an equity account is a credit. Treasury stock is a debit. I know, it's fun and exciting. But basically, they've been buying back stock, and you can see they've bought back, they spent about $4.5 billion buying back stock over 9 months, and the stock has been going down, okay? They have some additional paid-in capital, which is from share issuance or employee stock options. Retained earnings has gone up. That means they've recorded profits. And then accumulated other comprehensive loss. There are some items that pass the income statement and go directly to the balance sheet, but it's almost insignificant when it comes to PayPal. So balance sheet's fine. Now let's look at their income statement. So we can see their revenues grew, but I think the big concern with PayPal is their transaction margins, because what's happening is there's so much competition that it contracts margins over time. There's 100,000 different ways to save money or send money, some of which is free, like Zelle. You can Zelle people money for free, and I need to start doing that myself because every time I get paid through PayPal, I get charged like 1%, 2%, 3%. It's pretty freaking annoying because I've been paid like $2,500 one time, and oh my God, they take like $50 out of it. Like it's a pain in the butt. Okay. So let's see what's happened to transaction margin. So you have net revenues and then you have transaction expense. So if we just look at net revenues and transaction expense, for the most recent quarter, their transaction margin was, let's do the math here, 51%, 51.4%. For the prior year, their transaction margin was 56.4%. So their transaction margins have contracted a little bit. Now, obviously, not all the revenues comes from transactions, but you can just relatively see that their margins from just their transactions are shrinking a little bit. So transaction expense has grown faster than revenues. Credit losses, I mean, a little bit of growth, but nothing crazy. They've cut some expenses on customer support. They've cut sales and marketing. They've cut technology and development. A little bit of increase in general admin and a little bit decrease in restructuring. So overall, they've cut some expenses to compensate for declining transaction margins. And overall, they've still been able to maintain pretty decent profitability. Now, let's go and look at their statement of cash flow. So, I mean, they have positive operating cash flow. You know, on the statement of cash flows, you reconcile from GAAP, which is, the accrual basis of accounting. You add back non-cash expenses, you subtract non-cash gains, and then you adjust for changes in working capital, which is short-term assets and liabilities on the balance sheet. But overall, you can see that they still have positive operating cash flow. I mean, it's a little bit of a drop, but it could be a timing issue. Let's see. Not really much PP&E purchases. Purchases and originations of loans receivable has gone down. Let's see. I don't see anything really crazy on here. We can see they're buying back treasury stock. That's the negative number. Yeah, I mean, not the worst statement of cash flows in the world. No really crazy concerns about that. Now, let's see. There's somewhere on here where it talked about customers. So here's the thing. PayPal has peaked when it comes to active accounts. Look at this. You go back to September 30th, 2022. 432, 435, 433, 431, 428. Their active accounts are shrinking. So the only way they're going to grow revenues going forward, if this continues, is to be able to basically hopefully have more transactions per customer because their customer base itself is shrinking. Now they're able to get revenue, increases in revenue because of transactions, but I get the feeling that over time, this is going to continue to decline. This is probably what Wall Street's worried about, is the decline in active accounts. This company's basically fully matured. I mean, and there's so much competition out there. I mean, this is not easy money stock. Okay, yes, it's highly profitable. Yes, they have good financial statements. Yes, they're probably not going bankrupt. But it's more than just that. It's in a highly competitive industry. So, I mean, overall, like, good earnings, but you can see their gross margins over time are shrinking. You can see their operating income has basically stayed flat. Their revenue is growing, but their active accounts are shrinking. And I think in the long run, I don't know how much you can continue to grow revenues if your active accounts are shrinking over time, which will probably continue to happen as there are more and more and more and more payment processors. So, okay, the stock's up 4%. Wow. It dropped all the way down from $300 all the way down to 51, and now it's at 54. Wow, this is basically the next meta. Yeah. Oh, price target of 83. You're going to make so much money, guys. We'll see. So that's kind of my thoughts. Not the worst earnings in the world, but I just don't get it. I mean, I guess you can do a small position if you want to play around, but this ain't the amazing growth company story that it was in the past. With these active accounts shrinking, not so good. All right, guys, have a wonderful day. Cheers.